Ladies and gentlemen of the crypto space, we're live on a Monday, November 20th at 11:30 a.m. We're going to check our notes today and see what the heck is going on in markets. So, historically, I mean, not just crypto historically, like real world historically, there was this concept called the business cycle. And what that basically means is credit expands, credit contracts, businesses receive capital, businesses destroy capital. They potentially go bankrupt. What the system has attempted to achieve over the last at least 15 years to a magnificently disturbing extent is intervention into the business cycle. That's exactly what happened in March of 2023, where banks, where they became insolvent, were allowed to either be consumed by other banks or papered over from an FDIC perspective or a BTFP perspective, and capital was prevented from being destroyed. Capital being prevented from being destroyed is equivalent to capital being added to the system, or it's the opposite of losing money. If you're not losing money, you're adding money, you're gaining money, and that's just the way the net economics crunches. And we have all of that still written everywhere. Capital destruction looms everywhere. Mortgages, housing is completely frozen. Commercial real estate is completely looking like it's going to roll over significantly. None of that has been cured. But the system is a net equation. It's kind of like the architect in the matrix balancing the equation. So there's a tremendous amount of cash in the system, and the liabilities is not the conversation about base money, but all these liabilities sitting in money market accounts is something like $5.4 trillion, I believe, just sitting around. So there's a variety of paths that may play out. Commercial real estate, all right, everything goes on auction and it gets bought for fractions of what were bought for or built for, and that cash gets put to work. Banks, their portfolios get further hemorrhage, they become further impaired. You have contraction of the banking sector. You have some capital loss, maybe. I don't think they're really going to allow much loss of depositor accounts. FDIC and BTFP are just a foreshadow of what they may do to protect the general public's deposits. And they do this for economic stability, and they do this for the unspoken political reasons. Uh, Capital loss from bank deposits under a sitting administration is the antithesis of what anyone currently sitting in administration wants for purposes of reelection. So, that being said, I'm prefacing this stream with these realities because the markets look good. And we've been waiting quite a long time to say that the markets look good. We're going to go over the technical data of why the markets look good. We've waited 2 years for this. And I want to give more context. The system is cyclical, and interruption of the business cycle, you know, has an effect on that cyclicality, but it also doesn't, because the historic business cycle was, in fact, cyclical unto itself. But there's other cyclical pressures in the system that have to do with the way capital flows through global markets, manifesting liquidity conditions, and those liquidity conditions are cyclical. And those liquidity conditions will produce favorable market conditions. And we'll look at technicals that scream favorable liquidity conditions are at least written in the directional cards we're heading into. We have leading indicators saying we're going to have favorable liquidity conditions that bolsters markets. So I guess a good thing to say is we look for confluence, suggesting where things are and where things are heading with regard to leading and lagging indicators. So obviously, if we have disruptions, capital destructive events, liquidity destructive events, we respond accordingly. So you play the market as it is now, you structure the market as now, you prepare for the future. And I guess the most important thing is to just always know what's coming. And that allows you to at least be mentally prepared for incoming volatility and to be prepared accordingly. Okay, so let's take a look at total. Total crypto market cap to get a sense of where we are, what we've historically seen with a liquidity destruction event, at least one, 4 years ago in March of 2020. So we are in an ascending triangle, or a rising wedge rather, with a breakout to the upside. Only in crypto do you have a breakout to the upside of a rising wedge. And that's a similar structure that we have set up for Bitcoin as well. The rising wedge, does it break out to the upside? Now, rising wedges, from a technical pattern perspective, are a trend reversal pattern. Directionality reversal pattern, you would typically see them break to the downside. But in crypto, you see exuberance and capital flows and fundamental analysis and overall the narrative of the space carry things uh, in a continuation direction to the upside. So Bitcoin can easily break to the upside. Capital destructive events. Let's take a look at total three again. So this was a different market, a different world back here. And look at the size of the circle. So folks coming new into the space are looking at something like this. They're looking at this. This is new folks getting into the space. But in order to get a sense of where we are in this tiny ass little circle, you have to understand these large time frames. And we're going back to 14, 15, 18, 19, and 22, 23. So that's almost a 10-year period to get a sense of how the market is going to respond in current conditions, considering recent history. 10 years is recent history, more or less. So the market broke down back in 18. It started to finally break out in 19, but that was pretty much interrupted by systemic instability heading into September of 2019, where the U.S. banking system failed. And then we had what is arguably voluntary systemic instability with what happened in March of 2020, but probably better, undertones of the systemic instability introduced in September of 2019 started to blow up. And whether it was a coincidence or not, that's an entire conspiratorial argument. But the markets reacted very predictably with a shutdown of infrastructure. People pulled capital from everything. When you need dollars, you sell anything that you could possibly get your hands that you can possibly get your hands on. Now, the bond market, we would have to inspect whether, and there was systemic instability in the bond market, and it manifested here in crypto markets. Anyway, probably the best thing that could be said about 2020 is that prior to it, there was no crypto market. This was all speculative price action on centralized exchanges. There was no stablecoin marketplace. There was no Ethereum mainnet. There was no DeFi space or emerging market of emerging markets as I talk about. This was all centralized exchange speculative price action. So when you sell for dollars on a centralized exchange and the crypto markets are going through such a bear event, capital flows out. What are you going to buy? It does nothing. There's no parking capital. What's the point of parking capital in a centralized exchange and having that counterparty risk? So the capital flows out. There's nothing to bolster the markets. So all of this makes a great deal of sense in hindsight. And what is very interesting with that hindsight perspective is something like this. Our bear market. So obviously from 22 to 23, very different structure as compared to 18 and 19, particularly because it's a completely different world. Stablecoins sat in excess of 60, 70, 80 billion dollars across a variety of chains. Ethereum mainnet 60 plus billion dollars sat parked. That didn't exist in 18 and 19. This market structure is much more stable, had a much more stable foundation, and behaved very differently, to such a degree that there was literally cash flow throughout the entirety of this bear market. 22 and 23 was very productive. The velocity was obviously down significantly, but there was lending and leverage, and there was speculative activity to a degree, but there was a realization process that occurred of what was this foundation of this economy, of this emerging market that was emerging, that was manifesting, that was beginning to show what it is, what are its components, and what is its functional utility, what is its enterprise. And that's where we are from a monthly standpoint. This chart looks remarkable. Let's take out the noise. Why do I have little white dots? And the time weighted average price. I love the time weighted average price because to me it's a consolidation of all moving averages, and it gives you a central price point over varying time horizons to get a sense of where we are relative to the average price. Hence it's time weighted. And it is broken out to the upside. It's at level resistance. So, above 463 billion. And we'll see very different price action as compared to what we've seen thus far. It's a bounce off the bottom, finally a breakout, but there's still a variety or a great deal of non-belief. But what happens is in crypto markets, considering how small it is and the potential for capital inflows, once the belief shifts and more expectation coalesces around the exuberant narrative that crypto is historically known for, these candles happen very quickly. And I think that's the threshold from a level perspective. I mean, this smooth air above, as they would say, between 461 and 638. Do you know what kind of price action happens in on-chain protocols, relatively smaller market cap assets, representative of actual enterprise? Between $463 billion and $621 billion, do you know what kind of insane price action you see occur? So I think conditions right now are pretty much set, and it's directionally indicating we're on the early stages of market exuberance, where we'll get significantly deviated from the mean. Never forget whether you're buying at a premium or receiving a discount. But this is talking to a community that hopefully has been educating oneself over the last 2 years and basically is in position. We should be totally in position, and you're just waiting, and then the market does what it does, and you're like, oh, cool, we expected this. So let's look at total for a second. Very similar market structure, albeit a rising wedge, broken to the upside with a level basically about here. We've reached basically a level. You get to $1.6 trillion, and Bitcoin will move, Ethereum will move. That's a lot of hundreds of billions of dollars. The whole market will move. And I think we've broken out from a total as well as a total three. So obviously total expressing that Ethereum, Bitcoin, and the majors, the large cap, the protocol assets, they'll move to a greater extent. And we're seeing what we typically see when total breaks out. We're seeing Ethereum start to express strength relative to Bitcoin. And that starts always somewhere. And it starts usually when there's a mean regression up And lo and behold, from a monthly perspective, you have a 50 SMA mean regression, Ethereum denominated in Bitcoin. This chart looks wonderful as well. It didn't even hit trend support. My expectation is that Ethereum denominated in Bitcoin will outperform. Currently still have a position in Bitcoin, and I've been tempted to allocate it just to Ethereum. Ethereum will outperform for a variety of reasons. It has been significantly more scarce as compared to Bitcoin ever since the merge. There's been a contraction in supply. You see that on ultrasound money. Digress for 2 seconds. Show you guys the chart. Not 837. That's since the burn. One more. One more. One more. So since the merge, the actual supply of Ethereum is down 271,765 ETH. Is that it? Minus 0.191%. Anyway, so point being there's a contraction in Ethereum supply, and Bitcoin has an expansion in supply. So this is much more favorable conditions, and this bolsters the argument that Ethereum will outperform Bitcoin uh, in the near term. So that's my base case. So why are markets very much doing what they're doing? They finally got the dollar under control for at least a period of time. Markets are cyclical. Plenty of reasons for this to be interrupted and resume uptrend. You have to zoom out to really get a sense of directionality in this chart. You really need the 3-month chart, but the monthly chart gives us a sense of where we are today. Shorter term time horizon. These two circles over here, poorly drawn because of the monthly time horizon, represent everything that the general public has ever defined as a bull market in the crypto space. And you see it expressed in dollar weakness. Why? Because dollar weakness is the strongest indicator of foreign fiat strength, and that is increasing liquidity conditions globally. When have we seen the strongest expression of liquidity as it pertains to strength in crypto markets? When the dollar falls through the time-weighted average price on this monthly chart. Obviously, at the end, Q4 2022, we saw crypto markets bottom, more or less. They bottomed all the way until the time-weighted average price, January of 23, and we saw strength heading into 2023. At least bottoming, not further significant moves to the downside. I think slowed down in August, give or take, and that's exactly what is expressed here in the chart because folks feared invalidation of the continuation of the downtrend. But now we're seeing that this breakout to the upside of the time-weighted average price is being invalidated. There's 10 days left for this monthly candle close. If it closes below where we are, give or take 103,610, that would be invalidation of this entire move to the upside, which would be confluence of this breakdown in the time-weighted average price to the downside on the monthly chart. There's still support below. And if you notice, back here in 18 and 19, we did ride the 50 SMA to a degree. 50 SMA did have an expression of support, or maybe it was a deviated expression of support on the time-weighted average price. But we have pretty much reason to believe there will be continuation of the downside of the dollar until below 100. Below 100 is a big psychological threshold. That was a big breakout to the upside. It was unexpected to get there, but it's inevitable to get there considering the global debt construct. Be a big relief on Japan, and Japan finances U.S. Treasuries. Anyway, so 2024 is shaping up to be a very interesting year. They really need the dollar come down. They need pressure to come off the yen. They need Japan and China to be in more favorable conditions to consume the amount of debt that the Treasury has to issue next year to refinance outstanding debt. That bolsters liquidity. Dollar coming down bolsters liquidity. And this is why the banks and talking heads are screaming smooth, soft landing. And then what does that mean? Soft landing, considering what may occur with regard to mortgages being frozen and commercial real estate, I probably point to this aberration in like March of 20. We have our directionality set because that's what the system needs to proceed. You may have a significant aberration to the downside in markets. What kind of forced selling would we expect in a liquidity destruction event? I think they would be less compared to 20. There's more of a narrative of why capital is sticky now compared to 2020. So I think we'd see less of a pronounced effect because we know they intervene with regard to liquidity, and then the whole argument could always be made: what happens if their interventions are no longer functional and it's doomsday and it's post-apocalyptic scenario coming online? You don't bet on that because then there's no one to settle the trade if everything completely gets destroyed. So it's irrelevant. It's a non-starter from a capital management perspective. So all of that supports you own your position, you manage your portfolio, and things are going to head in the right direction, even if there's a capital destructive event. All that does is increase the amount of time required to get to the most favorable conditions. We're in favorable conditions right now. The directionality is being told to us right now. Whether that time between now and the most favorable conditions is X or X plus 5, it's still the directionality and it's still the destination. So these market conditions are very comforting because once you've bottomed, you're going up, and up means something very obvious from a norm, what is expected from the crypto markets, and that's exuberance. So in this regard, we have our targets. What do you expect Bitcoin to produce? What do you expect Ethereum to produce? What do you expect the overall DeFi space, the emerging market of emerging markets, to produce? So we have the portfolio constructed according to those expectations. We have the directionality saying those expectations are coming in the relatively short future, a year, 2 years. So this is kind of like sit back, relax, and let the show go mode. And that's what we have wanted. That's what this community has wanted. And that's why we've spent the time we've spent. Let the show go on. We're ready. And I very much look forward to it. So this is, as I've said over the last 2 years, why we inspect markets is to find comfort, to be able to allow markets to play out and not sit here with anxiety and frustration. And now we get to see the fruits of those efforts because now we get to sit back and let the markets play out, and we're like, yeah, they're doing what we expected them to do for quite some time. 26 people made it past my opening monologue. Tapsy's in the house. Oh, Gaffer, DeFi Futurist, howdy. Clouds and trees in your title screen look like the world map. So cool. Yeah, I love that stuff. I love those images. Diego, hola family from Italy. Bienvenidos. Welcome, enjoy, and welcome to Rationality. Asmith, good morning. Asarco, hey, hey. Hilda's in the house. Diego, one lesson I've learned in the last 3 years is that I should not buy a token in the first few months of its life. Prisma is interesting, but I think it's too early to be exposed to now. What do you think? I think an interesting statement is, what is there, about 24 tokens in the entire crypto space that I give a shit about? I think less is more. I think there's very few very core viable enterprise in this entire space, and everything else will have an exuberant narrative, will go wild at some point just because it's going wild, and that draws in capital and there's velocity and momentum. But what has, staying power? What has the narrative that says its infrastructure. And there's not many protocols. It's very few. So I think your statement is reasonable from a risk management perspective. I don't necessarily think it's the case with Prisma, particularly because of convex integration from the start. So its circulating supply has been significantly disrupted. The hyperinflationary emissions have been consumed almost in entirety. Liquidity is barely there. Um, Prisma. So we're at 6 mil liquidity. The price has been extremely stable, which is remarkable. Like, obviously aside from the dump, because that was just the unlock, and that went down to a mere, it was 30 cents. 30 to 90 cents. These are types of ranges that are not atypical for crypto markets, especially considering that kind of airdrop. So this has been relatively horizontal. Why? 70 cents. That was the bottom here in November 26th. So this is obviously very new. So you're struggling to get a sense of what this thing may do from here. Horizontal. So this is very horizontal price action. This is the expectation for a token like this. Uh, the aberration to the downside invalidated. It's back above this 73-cent line. Trend break to the upside, retest one. It looks like it's retesting two. What's fascinating about tokens like this is that they're not designed to go up in price significantly. Now, clearly, in an exuberant market, you'll see ridiculous appreciation. Look what happened to Curve during that well-known period and its all-time high. So you see significant deviation from the mean. So you don't have moving averages. You don't have a time-weighted average price of this on the weekly chart yet. So you don't have a sense of what the average price is. So how deviated is it from this average price? And price action will deviate to the downside where there's a discount and deviate to the upside where there's a premium. So we don't have time and market as you're talking about to get a sense of what the hell this thing is going to be and do in the future. But this asset falls into the category that I lump curve convex and the whole series of federations in. I don't expect significant appreciation of the asset. And that's why these assets are not understood. Like if this is in 2030 is $2, $3, be like, all right. And depending on tokenomics, if I haven't inspected granularly, but if the emissions are less than something comparable, it's less inflationary. They're maybe more favorable to be $5, $6, $7, $8 in 2030. The expectation is an appreciation. It's getting diluted on a daily basis. So this is an XYZ protocol. X is how much does it cost, Y is how much is it paying, and what is the likelihood of it continuing to pay that in the future. So this is pre-emergent, meaning how much does VE Prisma pay? Nothing right now. What is its potential to pay in the future? Hidden Hand and Vodium are coming online, and those are vote rental mechanisms. This protocol has the potential to pay very soon. And one thing we know about Prisma is that it's immutable. The contracts deployed cannot be modified. So it has governance and it has all those tweakable characteristics, but once it starts paying from vote rentals, it will continue to pay from a vote rental perspective, much like Curve has proven to be the case. And Convex and Aura and Balancer and Frax, they're just, it's going to keep paying from a vote rental perspective for liquidity financing purposes. So I think this protocol fits XYZ very nicely. So this is a very hard thing, especially for new folks to get into because they hear me talking about cash flow and they hear me talking about XYZ and they're starting with a portfolio size. And this comes back to the conversation. Can you really benefit from these types of protocols with too small a portfolio? And it depends, as I've talked about, geographical considerations. If you take $10,000 and you're making 20% a year, you're making $2,000 a year. In plenty of places around the world, that changes your life. Not necessarily in America. And it's dependent on expectations. If that's your expectation and you're meeting your expectation, then you're satisfied. You've met your expectation. But don't find yourself disappointed by this asset being $1.50, $2 at peak exuberance, which is probably lowballing. I'm gonna be lowballing these numbers. Like if I see curve above all-time high, I will be surprised. It is not my expectation. So what is that? Underperform, overperform, underperform, overdeliver? Underpromise, overdeliver. So I'm underpromising myself to have my expectations met. I hope that helps. There's different types of protocols in the crypto markets as compared to traditional equities that have very different characteristics of an equity. They produce dividends, there's cash flow, there's revenue from these protocols, but they have properties of currencies, they have properties of sovereign bonds and geopolitical arrangements that were done with sovereign nations over the years, and that's the whole federation conversation, sterilization, and recycling I've talked about over the years. I like this protocol. I took a position in the protocol. Very rational in size, 1%. I've talked over the years, 1% to 10% changes everything. And that is not an argument that consists with the expectations of the vast majority of new entrants to crypto markets. Turning 10 grand into 10 mil is not what you're going to do with a protocol like this. Hope that helps. Killers, good morning, good morning. Tom, where the heck have you been, Tom? We need the captain back. And the captain's back. He's the captain. I might be captain of rationality, but he's the actual captain. Good to see you. Good to see you. JM, do you think it's rational to be dollar cost averaging into CRVCVX over the next 6 months starting now? I don't think you're going to see the performance of the asset that most people are expecting. It depends on your expectations. If curve gets to all-time high, I will be surprised. In an exuberant period, and that being my expectation means I'm probably undershooting where it will be from an exuberance perspective. From an exuberance perspective, it's going to blow past all-time high because that's what assets do. Is that your expectation? Is it's on my other screen. So 25% stablecoin revenue, CVX CRV, is what it's producing right about now. Is 25% your expectation? Is that kind of revenue going to meet your expectation? Because I know for a fact the vast majority it will not. But that's an extraordinary number. And over years, over a decade, 25% compounding returns changes everything. So it depends on time horizon. These assets are not best suited for many, at least until digesting their how they will be productive and how they will serve your portfolio. These would not qualify as growth assets. These are value assets, which are totally fascinating because of the degree of dilution. And if we talked about this from an equity standpoint, anyone in equities land would say you're nuts. But you have to understand what the U.S. did with Saudi Arabia and dollars for oil and sterilization and recycling and what's literally going on right now with regard to fiscal dominance and coordinating geopolitical collusion to get foreign nations to buy our bonds, to finance our fiscal policy, which in turn floods the international market with collateral. And since '08, the entire Eurodollar market requires collateral to print dollars. So it requires understanding of these global financial macroeconomic systems. I hope that helps. It's a lot. A million. Scotland in the house. Much a pleasure. Appreciate you. Hilda, opinion on cash swap token could be very interesting. I only use cash swap to swap. Occasionally, I'll go to like Curve or something, or if I can't get a bid that I need, I'll use something else. But cash swap is the go-to. Fees increasing a lot. Rumors about rev share. Rumors, speculation. What's the most important thing? Is it paying now? So this, what you're talking about, fits into the category of it's probably going to pay in the future. Is it likely to pay in the future? Possible. Yes, it's possible. Is Prisma more likely to pay in the future? Yes, because it's literally like set up to with hidden hand and Vodium. Is CowSwap possible to pay in the future? Sure. Do I wish I had a moderately sized position? Sure. It has moved very nicely. FXN as well. A lot has moved very nicely. I'm not going to be taking a position in cow. It has moved past my threshold for entry. It has moved already. It has garnered attention. I wouldn't be able to attain the position size I want, and certainly not the cash flow that I want, even though it's speculative to produce cash flow. It could produce a huge amount of cash flow in the next decade, and it could be the best investment of one's life. But you can't invest in everything, and that's just where you have to fall back on your rules and your best practices and your fundamental methodologies for managing capital. There's no reason not to carve out half a percent, 1% here and there. Big punts with large time horizons, which are quite reasonable. Took a punt on a lot of things back in 2015. So that's why the smaller positions are meaningful. And you know, can you carve out 1%? Is it available or is it not? So these are the types of conversations you have to have with oneself to assess, is a position even possible? Hope that helps. DeFi futurist, is Prisma better than Curve and Convex for someone to come in now? Uh, okay, so the world reduces to ROI. If you buy a house for $1 million and it's producing $100,000 a year in rental income, it's producing 10% APR, minus obviously capex requirements for maintenance. It's whatever. Point being, it's 10% APR. If you buy CVX CRV today, it's producing 25% APR. If you buy a US, whatever, 2-year bond, it's over 5% APR. Then the other part of the equation is X, Y, and Z. What is the likelihood that it's going to continue to produce that APR into the future? So everything in the damn world reduces to the same equation. It doesn't matter what it is. It's X, Y, and Z. So it may be excess diversification. It may be that it does the exact same thing and it's the same degree of productive that V curve would be or that convex would be, because I don't really care much about appreciation of the portfolio. I care how productive it is. If the portfolio is producing a quarter mil a year, then it's producing 300,000, and in 5 years it's producing a half a mil, and then in 10 years it's producing 750,000 a year. I don't care what the portfolio value is. I care how productive it is. So I guess I'm trying to provide statements that give more depth and richness to the type of questions that need to be asked to understand these markets compared to is something better than something else. Better how? How will it meet your expectations? If you're going to lock Prisma as VE Prisma, you can't unlock for 52 weeks. You could easily miss top with regard to exuberance, which means from a capital gains perspective, you're going to miss the capacity to optimally capitalize. It's probably not the right asset to be looking at. It's probably best from many perspectives, and more or less my perspective, to stick with something that has high liquidity, that is not extensively deviated from the mean, that has yet to really break out. And that's kind of Ethereum. Ethereum is still below resistance at 2023. It hasn't broken to the upside and it has a favorable trend structure as compared to Bitcoin. Bitcoin's already broken out. Bitcoin's in a rising wedge. This is an ascending triangle by almost any reasonable technical evaluation. So Bitcoin's already broken. It's a rising wedge. There's no reason Bitcoin can't retrace the 31 and anyone say, oh yeah, it makes sense from a technical perspective. It's a rising wedge. I think Ethereum outperforms. That's written in this chart. It's not even like a fundamental analysis why Ethereum outperforms, and you could have all the conversation you want about increasing scarcity and deflationary pressures and all that shit, but it's literally written technically why it will outperform against Bitcoin. Try and take the emotion out of it and try and take the fundamental analysis out of it sometimes as well. And technically has none of that. There's no opinion, it's just data. It has outperformance written in the chart. This is a triangular compression that dates back to 2017. It is a massive triangular compression. And what's the expectation from an Ethereum perspective? Bitcoin could do like a 10x. I think diminishing returns are what to expect. And they did a 20x from trout to peak in 2020. 3,000 to 69, it's about 20x. So Bitcoin does a 10x next cycle. I'm pretty sure it's meeting everyone's expectations. I don't think it goes much beyond that, and there's potential for it to do anything. We assess when things actually do something, but that's pretty much my expectation. Ethereum, 20x? Listen, 20x on $10,000 is $200,000, and that's a good first cycle. But that also means understanding how to assess where we are with regard to systemic liquidity, potential tops in markets. And that's why it's absolutely mission critical to understand the dollar, to understand what's going on with bonds. You can get a general representation of treasury market activity from TLT. This does not have bottom written all over it at all from a moving average standpoint. So you have to understand bonds because bonds are collateral and collateral is dollars outside the US. And everything is liquidity. When there's excess liquidity, people buy things. If you have an excess 50 grand in your checking account and you just got it, you're probably not going to spend it right away. But let's say the market is calm and nothing's really going on and that $50,000 is just sitting there. What happens is it gets itchy. You're like, well, maybe I'll buy something. Maybe I'll buy a phone or a car or I'll go out to a nice restaurant because you have it. It's getting itchy. Money gets itchy. So that's exactly what happens with this move indicator. When the volatility falls over, and it hasn't yet, so that's why we're still in a state of market doesn't really know what the hell is going on. That's the market going to start to get itchy type of presentation of data. This rolls over, the market's going to get itchy, and there's a lot of dollars just sitting in the system. So you get a sense of where tops are and bottoms are. The smaller portfolios probably need to profit from a capital gains perspective to build up a larger amount of capital, depending on your expectations. Listen, if you're trying to make $2,000 a year and you're in a small African country where $2,000 a year changes your life, that's pretty cool. And I think you could get 10, 15, 20% pretty reasonably with without excess risk in these markets, which means you're outperforming the risk-free rate of return of 5% from U.S. government debt without taking on excess risk. And I think there's more of that excess risk to be seen in equities, yet alone the frictions to access them. Less friction to access these assets probably in many rural places around the world. Hope that helps. Crypto Jake, one curious view. Appreciate your opinion, Hilda. Much a pleasure, much a pleasure. Diego, speaking of cash flow, the Ethereum blockchain is earning on average $7 million per day through gas fees. Are you interested in participating in the business of Ethereum staking? Position size. If you have 10 mil, you just grab, 4 or 5% and call it a day because your collateral is just going to exponentially appreciate uh, through the exuberance, and you go 20x on your principal, and you're producing 4.5%. That's crazy. It's pretty much risk-free rate of return, dollar denominated, except you're going to have the volatility because it's not dollars, it's Ethereum. So you're going to have um, your bear cycles as the dollar strengthens, and so on and so forth. The cyclicality of these markets. There's plenty of folks that have just large piles of Ethereum, and they pretty much treat it as savings, as cash, and that's why I define it the way I do. I define it as a cash. I define the Bitcoin as a cash. Which one is a better cash? That's such a subjective argument. But to me, it's irrelevant. What's pertinent is that it's a cash. You could spend it. You could put it on a debit card and spend it in a supermarket, at a convenience store, at a gas station. You could spend your Bitcoin in Ethereum. And then what's pertinent is from how you manage it from an FX perspective. And that's why you have to understand liquidity. You have to understand the DXY. This is a great chart, particularly because it's the culmination of yen pressures and their catastrophic, you know, fiscal situation, their bond market and interest rates. When the move indicator, whether move rolls over first, maybe move is a leading indicator on dollar liquidity. So this is a leading indicator on systemic liquidity as well. So you still need confluence, but this is a great representation of when international liquidity conditions are about to frickin' tidal wave through the system. When the dollar comes down, liquidity floods the markets. So from an Ethereum as an investment standpoint, I don't think of it as an investment. I think of it as cash. But you're gonna have to manage it from an FX standpoint. Only in crypto can you get a potential 20x return on your cash position and just manage it from FX and swap it out as the dollar bottoms. It's going to be very interesting where the dollar bottoms. This structure is just wild. We've been in a dollar bull market since 2008. Horizontal dollar price action from 2015 to 2021. This is really a chart that tells a story of the world, geopolitics. It's a wild chart. I mean, this is literally the crypto bull markets in the two circles, and this is 2023 where crypto stabilized, and now the shorter term time horizon is really favorable conditions for the crypto market, invalidating the break back above the time weighted average price. I'm looking for a continuation to the downside for a variety of very rational reasons, which should be cyclical for a period of time. How long will it go down is irrelevant. It goes down, and then you see where a bottoming condition is forming, or support is starting to express. And then you could rotate out of your FX assets to the appreciating dollar. you find support on the 50 SMA, there could be reason to rotate capital out. You see moves spike, you're in the process of some sort of systemic collateral event, you rotate some capital from the volatile FX pairs, Bitcoin and Ethereum, to dollar denomination, dollar liabilities. You see this spike to 180, you're probably should be freaking out a little bit. I mean, anything above 120 and you should be rotating FX to dollars. So we look to move, we look to the dollar to assess how we rotate and manage the cash position of the portfolio, Ethereum, Bitcoin, and dollar liabilities in some on-chain form. Hope that helps. Loki, hey Noah, do you know Retro and Polygon? They've been doing a lot of fees compared to their TVL. Seems to be generating a lot of revenue. Are you interested in these smaller D apps if they have cash flow? Uh, Me, no. I say that because I don't need to be exposed to the smaller protocols. I want time-tested, mother-approved base layer infrastructure that is more likely than less likely to be here in 2030, and I don't need a smaller enterprise. I don't need to take on that excess degree of risk. That's because of my experiences in these markets. That's because of my portfolio size. That's because of my risk tolerance. That's for a variety of reasons. And that also means I'll miss a lot of very powerful moves, miss a lot of appreciation. And that for me is okay. I don't need to make more. I want to make less. I want to make more in a more reliable way. I want to be more confident of where things will be in 2030 rather than taking on excess risk. So consider that as well as all the content we've discussed so far this stream. SIJ, good morning. Do you see anything in the Solana ecosystem with longish terms? Yes. So I have a high opinion of Solana. I have a high opinion of Cosmos Hubs because of the East narrative, as I've discussed over the years. I think Solana hits the enterprise narrative. I think Polygon as well has some serious legs. I mean, that has the India narrative, as I've discussed over the years. Solana, let's look at the chart. So it's extremely deviated from the mean. I see all the reason in the world for a nice pullback to at least the weekly time weighted average price. Maybe not the TWAP, maybe because its market has a little bit of froth and exuberance. Maybe see a pullback to the 100 SMA on the weekly. Where was that? Yeah, I don't think we're going to. If we find support on the daily time weighted average price, that'll be fascinating because that's it's a pullback for ants, so to speak, to 54. But a nice healthy pullback would be a pullback to about 42. So this is a tremendous amount of capital inflow and validation of the market. Has early, first cycle 2020 Ethereum mainnet vibes. I I'm not interested in it. It has significantly moved off the bottom. I don't need it part of the cash position. It's too late in my opinion. I don't need the kind of exposure. But my general opinion on Solana is Hero Network. I find it to be just covers the entire Solana ecosystem. Um, so one asset to rule them all on Solana, in my opinion. And the potential is large, which means you don't need a large position. An opinion that I have is that if you expect something to outperform significantly, you need less of it. If you expect something to outperform marginally, you need more of it. Because I want my portfolio to be balanced. And that's a very contrarian opinion. I don't want the max productiveness of the portfolio. I do not want to make the maximum amount of money possible merely because it's contrarian. It doesn't make sense. It's the opposite of what everyone does. And I'm just hell bent on being weird and different. So the best expression I could think of for Solana is Hero Network. And I think if Solana does what its potential is, I think I think all the exposure I potentially need to Solana it allows I can have that exposure vis-a-vis a relatively modest, it's not even a large position in Hero. Small position if you expect it to outperform. That makes sense. 1% of the portfolio to 10% of the portfolio changes everything. And this way, you're not taking a lot of risk. Small bets do big things. You change the entire portfolio forever. And that's the way I like to do things. Hope that helps. DeFi futurist, I want that 20x. So bear in mind there's a difference between a 20x in portfolio growth versus capitalizing 20x, which means like you hit Ethereum at 2,000, it goes to 40,000. You would have had to sell $4 at 40,000 and perfectly assess the liquidity conditions of the planet. Watch the dollar, the DXY completely bottom. Watch the yen probably collapse from where it is further. Watch the bond market do some weird shit and the system go through convulsions and wait over a 2, 3 year period for the market to bottom, sitting in cash. So that's the complexity with cash as an investment. It's not an investment, it's FX. And I guess, FX traders may define their behavior as investing. It's trading. It's conversion of one currency denomination to another, which really requires work and monitoring the overall global currency market. And because currency is a manifestation of collateral, you have to monitor the collateral markets. You have to understand the bond market and the currency market and geopolitics to boot. So 20x is cool. It sounds great, but there's a lot that goes into it from a sustainability standpoint, a process standpoint, a management standpoint, and an expectation standpoint. Hope that helps. You're very welcome. What do you mean by Solana potential? So Solana fits I like to generalize, stereotype, I guess maybe. I define Solana as enterprise. That's kind of where it fits into the way my mind sees these systems. Solana hits my enterprise narrative for enterprise blockchain. It's speed. You could, at once it reaches its TPS potential, you could run Fidelity on Solana. Stuff like that. You could run Visa on Solana. Like, Polygon hits my India narrative. That's the way I define it, and that is a monumental narrative. The potential hungriness of the population and technical capacity and programming capacity of the Indian population is extraordinary. 1 billion plus people, and that's where Polygon and Matic came from. So there's a great potential for that to have, this snowball catalyst effect of development and activity on the network because that's where its origins are from. And Cosmos has greater interest in the East and integrations with the BSN and what China wants to do with how it wants to manage the population. And we don't discuss here the complexities, geopolitical complexities, and political complexities of the nations in the East. What we're trying to understand is the financial reality of the potential for these systems. So Cosmos Hubs fits my East narrative. The potential there is extraordinary. All of the potentials that I've just discussed are extraordinary over a rational time horizon. Target 2030 and reassess whether any of these are invalidated, but I think they're just going to be reinforced, solidified, and expand significantly. Hope that helps. What's your opinion on Solana having too much VC investment? VC is critical to systems expanding. It's imperative to understand whether it's parasitic venture capital by nature, venture capital is designed to invest and get an ROI over a reasonable period, exit their positions, or they call it an exit. That's what an IPO is. It's literally an exit dumping on the general public. So venture capital is not necessarily a bad thing. You just have to assess it part of risk analysis. What's important is cash flow and determinism and immutability. And are you buying at a premium or are you getting a discount? Listen, if you buy something where venture capital has exited, it's de-risked from an entry standpoint. If you're buying something where venture capital has exited and there's 10 million users of a protocol and it's 10% deviated from the monthly time weighted average price to the downside, okay, venture capital. It got the protocol off the ground. It provided its capex requirements, its operating expenses, has a community, it's paying cash. This is the holistic review of a protocol, and this is what's needed from an investment standpoint to assess whether something is a good investment or not. So that's fine. I don't generalize a whole market, Solana market as being bad, uh, or just I don't generalize venture capital as being bad. Everything requires a granular inspection to assess the degree of goodness and badness. 30 people made it this far into the stream. 15 likes. I appreciate all of you. Press that thumbs up button. Thank you very much. Thank you very much. 2019 on Ethereum. I mean, literally, it's just sitting at resistance. There's no reason you can't retrace to 1700 and change. Maybe you get some sort of issues with the yen and the dollar just turns around real quick and finds resistance to the downside of the monthly time weighted average price. Let's go back to DXY, wherever it is in my laundry list of shit that I watch. You could easily see a retrace back to 105 to the downside, which would be different. Why? If you see resistance at the time weighted average price, there was no resistance here. It burned right through. The monthly close in February burned right through. It's the weekly. I mean, literally week to week, it just burned right through the time weighted average price. Burned right through back in May. Burned right through back in August. But if you see nice resistance, if you see nice resistance and a rolling top and then a lower low, that'd be very comforting, actually. Now, I wouldn't be surprised. We're in November, and this would push off further breakouts in the crypto markets into Q1, Q2 of next year. And it would be comforting from a technical structure standpoint. You want to see previous resistance flips, previous resistance flip support to the upside, and in this chart, you want to see previous support flip resistance, and that's a point of confluence. Hope that helps. Stargate above the weekly TWAP, resistance above the 50 SMA, expression of resistance over a 2-week period. Zoom out to the monthly. Tried to break through the monthly TWAP, which is relatively new founded. Clearly rejected thus far. 10 days left in the month. 10 SMA above head. Solana we talked about from a weekly perspective. A nice retrace to the 100 SMA would be interesting. No reason you can't get further deviated from the mean, but the further deviated you get from a mean, you're buying at more of a premium. Listen, you could buy it at $70. You're so deviated from all these means, and the rational exuberance of these markets carries it to $800. And then it regresses to $50. So that's the problem with deviating from the mean, and that's why it's so imperative to zoom out to high time frames. Hold on, I'm going to end on this note. This is a wonderful perspective to have. Zoom out to the 3-month, hide everything, and let's do this. Let's do this. Plot background. Let's hide. Yeah. Okay. So this is the price of Ethereum, the average price of Ethereum on the 3-month chart, which is pretty much up only, as you could see, which means if you buy any time below the time weighted average price, in 3 months' time, on average, the price of what you bought at will be higher. That's what the average price means. So right about now, you're buying at a premium. You could easily see a mean regression to the time weighted average price is currently 2030, and then average price is 1860. And let's say it's in pretty much a systemic liquidity event. You get a deviation to the downside, 17 and change, which is some of the moving averages we see on the shorter term time frames. But when it's at a discount to the average price, you're buying at a discount. So buy at a discount, sell at a premium, deviation to the upside. It could it could keep going higher and higher. And it's the same thing for the downside. That's what we say at like December of 21. It's like you're going to be surprised how low it goes. And newer charts, you don't have this kind of average pricing to get a perspective from, but you'll see those deviations to the downside, and that's greatly expressed on like a Bitcoin chart. I mean, look at the deviations to the downside. 1650, but the average price was 26,000 on the 3-month chart. So when you're buying below the average price, it's at a discount. When you're buying above, you're paying a premium. And the odds are everything mean regresses at some point. And that's exactly what you see here. Mean regress from the upside, burns right through the time weighted average price, deviates to the downside, mean regresses from the downside, hovers around the average price for 9 months, and we're finally breaking out to the upside. But now you inspect the shorter term time frames, which are actually pretty comforting from a time weighted average price perspective. We do have this rising wedge structure, but it was a breakdown, a breakout, and thus far a retest from a time weighted average price, which means likelihood of continuation to further deviate from the average price to the upside. Anyway, long story short, that's a lot of shit. Last couple of questions and comments, and I'll wrap it up. DeFi Futurist, you're very welcome. What's your opinion? And so I got that one. Great input. Thank you. Late to the call, but good afternoon. Always a pleasure. Always a pleasure. Yes, Polkadot is used in Asia. I didn't even mention Polkadot. I meant Cosmos hubs, or I mentioned Cosmos hubs. Polkadot's another story. Look at the structure on the chart. Right up against the time weighted average price. It was pretty interesting when it pushed above it. This thing's been beaten up horribly. Potential on it is quite interesting from a technical standpoint. Um, Really want to see it push above the monthly time weighted average price, but deviate to the downside. Clearly, it's very early, meaning you don't have a sense of what the hell this thing's going to do. This is like if you want to ladder these types of protocols and get some sort of perspective, you compare it to like Ethereum. So I'd say Solana is pretty much a commonly thought observation. Solana is behaving like it's 2020 Ethereum. Whether Cosmos and Cosmos hubs are in line with Solana or not, maybe it's an earlier cycle vibe as compared to Solana, but there is all the DeFi infrastructure on the Cosmos hub. So I don't know. It's kind of interesting territory because of how it works with seamless cross chain across the hubs. And that's kind of the same thing that's the case with Polkadot and the parachains. So this has very early vibes. You just don't have the technical data to assess. You know, look at these damn monthly TWAPs. How you can assess anything. You need the data to really assess whether you're buying at a discount or paying a premium. Do you have an opinion on AI? Not from an investment standpoint. I don't like. I don't want equity exposure because I know they're just going to. The whole purpose of being public is to raise money from the general public. So you issue shares and you dump it on the general public and they buy it, and that's how a company raises capital. So I don't want to be part of that regime. I'm not. It's a different argument and narrative for what goes on with dilution in crypto markets as compared to dilution in equities land. AI is going to change everything. I use it on a daily basis. There's crazy, crazy systems, and it just does incredible things. It's going to simplify everything and automate everything. It's robotics as well. I don't think it's maybe 2010s, 2020. Oh my God, 2010, 2020. That's how old I am. Maybe 2030 is early. Like 35, things are going to really start to change, and demographic collapse. We're going to start to see a lot of robotics, and what is work is changing. Entry level is changing. I mean, you don't need a lot of entry level anymore. So, just the whole structure of society is changing. That's exactly why China's doing what they're doing with regard to these new pilot cities where, like 10, 20, 30 million people are living in a brand new environment where you have, straight up CBDCs, and they're literally pilot testing new forms of society. It's going to be an interesting couple of decades to come. Yeah, Thorchain is pretty cool. Uh, Not too fond of it from an investment standpoint, but I have it here. I mean, you could literally, that's how you get capital from Cosmos to Ethereum mainnet. You could literally swap native Atom to USDC on Ethereum mainnet. This is one of the few places to do that. This is really cool tech. I'm not too interested from an investment standpoint. The yield is meaningful from an LP perspective. I think it was 24%. We've seen Eric Voorhees mentioned recently, but you can get 24% elsewhere without, you don't have to excessively diversify. As I said earlier, 20% is 20% is 20%, no matter where the hell you're getting it from. That's the fundamental reduction of the entire equation of an investment, the ROI. Bear in mind, 20% translates to a 5-year ROI. It takes 5 years to get your money back. Food for thought, food for thought. Let's wrap it up for today on a Monday, November 20th at 12:41 p.m. 32 people made it to the end of the stream. Hit that thumbs up button. I appreciate all of you. Tell everyone to subscribe. In the description is a link to the most rational community in the entire crypto space. I appreciate everyone that survived the bear market in there. Wonderful, wonderful people that have made very, very rational decisions. I will see you guys later this week. Peace.